然后今天的话，今天下午是我们邀请了新加坡国立大学冯一帆教授来给我们在这个呃资产投资组合这个管理的方向上做一个介绍。那么这块呢，它主要的是通过模型驱动和数据驱动两种研究思路来给我们做一个介绍。那么冯一帆教授呢是在芝加哥大学拿到了博士学位，然后在新加坡国立大学就职。他的研究方向呢，包括营销分析、平台运营、动态学习以及实验设计。那么接下来我就把时间交给一帆，好吗？
好，谢谢金老师。
哎，好的，好的。
好，谢谢金老师。
嗯，
各位同学好。因为这个课会有一些术语的原因，所以接下来我就切换成英文了。如果同学们还有什么想课下这个交流的话，我们可以在课下以这个一对一的方式进行交流。Okay, so thank you everybody again for coming. So in these two lectures, I would like to introduce you to the topic of portfolio management. So I know some of you might have heard of this topic or even studied it before, and some of you might not have. So the general strategy for today is in the first part, I will try to introduce some of the most classic and well celebrated theories and models. And then tomorrow I will talk about, given historical data, how to construct an effective portfolio in practice. I will summarize and share some of the existing tools, and I'll also talk about my own perspectives and understandings. Okay, so game plan for the day. I'll first talk about the modern portfolio theory, which is a decision framework based on the mean and variance analysis to think about how to construct portfolios. And then it comes to CAPM, or capital asset price model. It is an economic model, which is both based on modern portfolio theory and also MPT, and some basic assumptions on people, how do they make decisions or how do they behave in the economic market. In the end, it will give a theory about the mechanism of the prices and how the returns are formed in the first place. So that's called an asset pricing model. They have many applications, and when it comes to portfolio construction, it will provide some guidance in terms of which assets are undervalued, and then it can hopefully improve the portfolio construction in principle. So factor models is a further development of CAPM in that flavor. So it replace some economic assumptions about how people behave with some statistical assumptions, so that it becomes more flexible. And the goal of factor models is it will become more effective in explaining and predicting the returns of the assets. So if configured correctly, it will be more effective in identifying assets that are undervalued, which in turn will help construct more effective portfolios. Okay, so let's start from modern portfolio theory. By the way, please feel free to interrupt me if you have any questions, and we can discuss. Okay, so the MPT starts from this problem of so-called asset allocation problem. So suppose an investor is trying to split his money among n assets. And throughout this course, we think about so-called static portfolio management. So that means you think about, you have endowment of some monies and invest them in the market and hold them, and without rebalancing for a certain amount of time, let's say 1 year. So a little bit more formally, a portfolio is defined by a vector of weights. So here, the weight WI corresponds to the fraction of wealth that the investor puts in asset I. So by definition, the summation of weights should sum up to 1. Pretty much equivalently, you can think of the investor's money is normalized, to be $1. So you're investing $1 into the market. Apart from that, we are not imposing any other constraints about the portfolio weights. So that is, the weights can be negative here, where a negative weight corresponds to selling or shorting an asset. So also we talk about a return of the portfolio or a return of the asset. So the return of the asset is defined by the related fraction of value increment. A bit more formally, suppose you have an asset, the price of it is PT in the beginning horizon, and the price is PT plus 1 in the end of horizon. Then the return of this asset is defined as the return of PP plus 1 divided by P of T and subtracted by 1. Of course, if you know all these numbers in hindsight, you should have invested all your money into the asset with the highest return. But the key challenge here is the return in the future is unpredictable. So we model the asset returns as random variables. Okay, so the investor, now we talk about the objective investor. So the investor is trying to come up the weights or construct a portfolio that has a high mean of return and a low variance of return. And these two metrics of a portfolio depends definitely on the weights, but also depends on the first two moments of the returns of the assets. So more specifically, let's say the expected return of each asset is mu I, then the portfolio return is the weighted average of asset returns. So that's the, we can express the expected return of the portfolio explicitly. And also, let's say we have the second moment information, which is the covariance matrix for the returns of the assets. So the covariance matrix contains a lot of information, roughly two kinds. The first one is on the diagonals. These are the variances. They talk about the uncertainties of the return of each asset. The second stream of information, which turns out to be even more important, is the covariances. So a covariance between two asset returns describes the tendency that the prices of these two assets co-moves with each other. So if the covariance is positive, they tend to move in the same direction, and the covariance is negative, they tend to move in the opposite direction. And then it's a number that describes how strong the tendency is. So once you have the covariance matrix of the assets returns, the portfolio return variance is expressed in this, a little bit nonlinear or quadratic form. Okay, so the asset allocation problem can be summarized as, suppose in this, at least in this lecture, the values of mu and v's are known to the investor. How to construct the optimal weight vector, where we'll discuss the notion of optimal in a minute. Okay, so know that up to now we try to avoid the discussion of explicit objective function as long as possible. So for now, the performance of a portfolio is evaluated by two metrics. The first is the mean, and the second is the variance. And then we can start talk about evaluating a portfolio and comparing two different portfolios. And the easiest way to do it is on a diagram. Okay, let me actually try to show you a diagram and hope that I won't incur any technical issues. Okay, so let me share. Okay, can you see this? Can everybody see this? Okay.
Yes.
Okay. Okay. So throughout the discussion of portfolio construction, I'm going to represent each portfolio in this so-called risk-return diagram. So on the x-axis, that's the standard deviation of the portfolio, and that represents the return. And on y-axis, that represents the expected value of the return, and that represents, the return as we think of, most intuitively. Okay, so we can, for any portfolio, let's start from the asset. So every risky asset can be represented by a dot. So here, this dot here means that this asset A has this level of risk, its innovation, and this level of return, right? So this is, let's be called sigma A and sigma, RA, right? And then we can talk about another dot. Let's say here, a dot B here. So you can see that in this particular example, a B is more noisy or more risky than A, but also has a higher expected return. So maybe you can think of A as a bond, and you think of B as a stock, right? So in some sort of sense, they are kind of incomparable because with high return, it brings like a little bit of higher risk, right? But using the same graph, we can kind of already compare some assets, in a special form, in other special forms. For example, if you have an asset here, let me call it B prime. So you can see that B prime has both less risk than A, but higher return than A. So basically, I would say the axiom here for the investor is the investor, when he compares A and B prime, he would definitely prefer B prime to A. So that's almost the only thing that we kind of assume now. So holding the same risk level, the investor prefers higher return, and holding the same return level, the investor prefers less risk. Okay, so these are back to here. So these are, let's say, two kind of risk and return for two assets. So what happens if you mix the returns, you mix the two assets into a portfolio, and then you get a lot of dots, and actually instead of dot, you get a curve, and the curve roughly looks something like this. Right? So this curve means if you vary the portfolio weights, what's the combination of risk and return that you get? And this curve, has endpoints of A and B. This is when the portfolio weights are now negative. If you allow shorting, then, So if you allow shorting, then it becomes something like this, right? So it can kind of, go to infinity. So this curve is what you can call an investment opportunity, the set of investment opportunities. If you combine, A and B's, you form a portfolio of assets A and B's, right? So this is the general case, and the exact shape of the curve for the two asset case also depends on the co-movement of A and B, or equivalently, it depends on the parameter called rho, right? Rho is defined as the so-called coefficient of correlation between the returns of A and B. Okay. Okay, so that's here for now, and let me continue. Okay, so if you have different value of rho, this is roughly what you get. So if the returns of the assets are perfectly correlated, which means a rho equals 1, you actually only get this this red curve here. And if the returns of the assets are perfectly negatively correlated, then you get this the combination of these two line segments here. So in general, when the value of rho or the correlation becomes more negative, the curve here kind of pushes towards the left. So, and then we can actually start talking about comparing the curves. For example, you have the three typical cases here. If you fix a level of return R, you can see that with appropriate value of the weights, the green curve can always achieve less risk or standard deviation than the black curve, and the black curve less than the red curve, right? So that's actually what we call the benefit of risk diversification, because once the asset returns are more negatively correlated, you can kind of get a free reduction of variances of the risks without compromising the returns. And the reason for that is because of the nonlinear structure of the portfolio variance. So more specifically, the returns of the portfolio is the weighted average of the returns of the assets. But the returns of the variance of the portfolio is not a weighted average of the variances of the assets. In fact, if rho is sufficiently small, you can actually construct a portfolio that has less variance of either of the portfolios, right? So as I explained, so this is economically corresponds to the benefit of risk diversification. So a little bit more generally, this looks like something like this, right? So in a risk diversification, which corresponds to the phenomenon that simply by mixing assets, which assuming may not be perfectly correlated, that actually reduce the variance of combination and improve the frontier of risk return opportunities. So if you look at the graph on the right-hand side, these kind of colorful curves, A and C, B and C, A and B, blue, the purple, and the orange lines, corresponds to investment opportunities if you only compare pairs of assets. But once you start mixing more assets, in this case A and B and C all together, you're further extending the frontier or the investment opportunities towards left, which is a thing that we want. So in general, the more assets that we add, and the more negative the correlation among the return of assets, the higher the benefit of risk diversification there will be. Of course, there should be a limit to this, right? So this gives you a flavor of how good the risk diversification benefit will be. So let's say if we include like a singleton or a very few number of stocks in a portfolio and call it the risk level to be 100%, and this is based on historical data. If you appropriately, for now I'm not going to go into details about how to define appropriately use the weights and diversify among, let's say, US stocks, and the risk will go down from 100% to around 40%. Actually, that's pretty quick, as long as you combine, let's say, I would say maybe 30 or 40 stocks, right? If you combine among a larger pool of assets, say all the stocks there, the international stocks, you can further reduce the risk from 100% to around 30%. So it's better, but it's also not down to zero. So in economics, actually, they have term to describe this phenomenon in the sense that they can decompose risk into two components. The first component is what they call idiosyncratic risk or diversifiable risk. So this risk corresponds to the parts where that's company specific or asset specific. For example, an R&D project for one company doesn't work out, and for another company, they try to launch a new product, but it turns out to be a failure. So these are idiosyncratic because it's company specific. So the hope for investor and the reason diversification could work is that, this one doesn't work out, but that one might have, right? So, and then this one go up, that one go down, and in the end, the shocks of each companies or each asset can kind of quote unquote cancel out. So it is this component of risk, or the idiosyncratic risk, that can be eliminated by risk diversification and improve the performance of a portfolio. So the limit that you can see here are those that cannot be eliminated by risk diversification, and that's called the systematic risk, right? So those are the risk factors that affect assets across the market. And for example, economic crisis, right? For example, interest rate, or you can say for US stocks, presidential elections could be one of the factors that definitely changes, or affects the assets across the market. Okay. So that's a little bit about risk diversification that I want to talk about. And now let's come back to portfolios, right? So I have tried to deliberately not introduce a very specific form of objective, although I can, because I want to keep it as general as possible. And without that, we can actually, instead of defining one single optimal portfolio, one can describe a collection of portfolios that one cannot beat each other, and those are called the efficient portfolios, right? So let me start talk about what are the efficient portfolios. At the first example, one can talk about a portfolio that achieves the minimum variance, and that's pretty well studied too. That's called the GMV, or the minimum variance portfolio. And the formulation is pretty clean. So you minimize the variance of the portfolio subject to the constraint that the summation of weights is 1. And this is a quadratic program, so it's easy to solve both analytically and numerically, right? So okay, so in general, one could think, okay, so this GMV definitely is unbeatable in terms of variance, but maybe it will not achieve a very high level of return. So in general, for every level of return, we can do the same thing, right? So we can formulate a optimization problem trying to kind of find the portfolio weights with the minimum variance, but achieving the given target return rate. Let's call it R bar, right? Again, this is another quadratic program, but instead of giving us one single portfolio, it gives us a single portfolio for every return level of R bar, right? So then you vary the level of R bar, you get a curve, right? You get a black curve right out here. So this blue curve is what they call a mean variance efficient frontier, right? So those are the ones for any given return level is unbeatable in terms of the variance. Okay, so sometimes you can do one further step, right? So you can see this curve actually, for some level of standard deviation, for some level of risk, you can see that it kind of can intersect with. There are two intersections for the same level of risk. In those cases, you can actually also eliminate the upper part, the lower part of the curve, and only talking about the northwestern, right? The northwestern part of the curve. So that part of the curve is called so-called efficient frontier, right? So in the end, also in principle, there could be a lot of different investment opportunities, but in terms of in terms of mean variance analysis, or in terms of an investor who is concerned with mean and variance of portfolio, it is the efficient frontier or the mean variance efficient frontier that is all that matters. Okay, so let me pause here, just to, in case there are questions. Okay. If not, so let me summarize what I have done now, right? So we have defined just by using dominance idea, dominance meaning if a portfolio has the same mean and lower variance than the other one, or has the same variance but higher mean than the other one, that this is called dominance. Just by dominance idea, we can narrow down the collection portfolio to be a very small subset of the investment opportunities. But then the answer is kind of still, I would say, ad hoc, because we still cannot find a single portfolio that can arguably give us a satisfying answer, because different investors may have different answers in terms of trading between the return and the risk, right? Some people might be more risk averse, right? Like you can think about a very rich person who just to try to preserve his wealth. Then he might be interested in the minimum variance portfolio. But some other people might be more ambitious, right? Their goal is to maximize the growth rate of their wealth, and they have a long time horizon, so they kind of are more tolerant with respect to the risk. And then they might just be interested in maximizing the return instead of think about this variance too much. Okay, so basically, different people have different attitudes towards the trade-off, risk trade-off, or it's called the risk aversion. So that seems to be an unaddressable problem when we are dealing with this efficient frontier story. If the story ends up here, it will not be this well celebrated. But now it comes to a when I first saw it, I found it pretty surprising, to a result where even based on this limited assumptions, there is this portfolio that merges up that can arguably be treated as the optimal, the portfolio. Okay, so this is called the tangency portfolio. Okay, so let me do it one by one. So the introduction of tangency portfolio is based on one additional assumption, which hopefully you'll find it pretty mild. So that is, among the pool of assets you have an asset with risk-free return. Let me call it R of F. So you can think about the risk-free asset as, let's say, the most classic one for risk-free asset is the treasury bill. Or you can think about, the treasury bill of, typically it's for the United States, but you can think about the treasury bill for China as well. So, unless the work broke down, it's probably the US government or the Chinese government is not going to default on the bill, right, on the bond. So that's usually a good approximation for a risk-free asset. Okay. So the result of modern portfolio theory, the main result, I would say, or the result with respect to tangency portfolio is the following. So suppose we have a risk-free asset, then every mean variance efficient portfolio, it should be efficient portfolio, no matter what that is, should be a linear combination of two components. The component of the first component is a fixed portfolio, independent of the mean efficient frontier that you're looking at. And that fixed portfolio is a portfolio among risky assets, and that's what we call a tangency portfolio. And the second is the risk-free asset. So it's just a combination of risk-free asset and a fixed portfolio that's the same regardless of your risk aversion level. Okay. And this can be most easily seen from a graphic proof. And let me show you that. Okay, so okay, so suppose in the market there's this collection of this collection of assets from A to B. Some of them better than those. That's okay. For example, in this example, A dominates C, but that's okay. And then we kind of solve that project programming for each different level of return, and then we get this curve, right? So this curve is the mean variance efficient frontier. Okay, and then we have additional notion here that's R of F. So as you can see, the standard deviation here is 0 because it's risk-free, and the return here is non-zero because that's the risk-free rate that you can achieve. Okay, so the question is how to construct the efficient frontiers that includes the risk-free asset, right? So the curve right here you see is the efficient frontier that only includes the risky asset, not including the risk-free asset, right? So, okay, so let's just pick one of the typical cases here. That's one of the possible investment opportunity among the risky asset. That's what you get if you mix the risk asset in a particular way. So that's one particular portfolio, right? And the question is what you get if you mix it with the risk-free asset. And because risk-free is is deterministic, you can think of it as perfectly correlated. I'm not going to the details of math, but you can think of it as perfectly correlated with that risky asset. So the investment opportunity, if you just mix between that portfolio, it's a portfolio, and that's risk. But now you can think of it as risky asset, combining all the portfolio together as one asset. If you mix risk-free and that dot, the collection of investment opportunities that you get is this, is this kind of this line here. Okay. Right. So now I'm showing you a collection of performance pairs, and that you can think of as portfolio, right? So it makes the risk-free rate and that dot with different weights, and you combine all the weight, you kind of plot each weight. In the end, you get this blue curve, right? So you can do the same thing for another dot. For example, here, right? So this is what you have if your kind of the weights among risky assets is correspond to the second dot, and then combining it with the risk-free asset. Okay, so what you can see here is that again, just based on dominance story, based on the dominance argument, I would say line 1 like dominance line two, right? Because at each level of return, line 1 can to achieve a variance that's less than the corresponding level of line 2, right? Specifically for each level, right? You can go from this point to this point, which is strictly better. So in some sense, you can kind of ignore line 2 because line 1, every point of line 2 is dominated by one point of line 1. So you kind of can ignore line 2. But further, you can kind of ignore line 1 too, right? Because you can find another line. Let me call line 0. That dominates line 1, right? Okay, so this kind of argument continues, right? Line 0 can also be dominant, so on and so forth. When does it stop? It stops when you can achieve a line with the maximum slope, but also is tangent with respect to that curve, the blue curve that I drew, right? Okay. So this dot, with respect to this dot, you can see that no matter what portfolio that I can construct, it can be understood as a line, a dot on some line with some dot on the black curve. And that's definitely dominated by this final curve that I drew, right? And this final curve that I drew corresponds to a portfolio on the black curve, which is a portfolio among risky assets. And that portfolio is called the tangency portfolio. Right? And correspondingly, right? Let me actually use another color. Let me actually use another color. Sorry, let me actually use another color. Okay. 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 So this green curve is actually the efficient frontier when you can include a risk-free asset. And the intersection with dot is the tangency portfolio, right? And this blue curve is so kind of special. It has a special name. It's called the capital allocation line. Why this is called the capital allocation line? Because in the end, for mean variance portfolio, no matter what your kind of risk aversion level is, your final choice of portfolio, I don't know which one it is exactly, but I know that it's definitely on this green line. So everybody's capital allocation is on this line. That's why it's called the capital allocation line. And there's another meaning for portfolio on this line. That means that the portfolio, because it's on this line, it's a linear combination of the risk-free asset and this asset called T, right? That's the tangency portfolio. And furthermore, there's a third interpretation of this line. That's by looking at the slope. Okay, so what's the slope of this line? The slope is, let me write it here. The slope of this line is the expected return of this particular portfolio. That's the tendency portfolio. Actually, the definition is well defined for each portfolio, but now we are focusing on tendency portfolio. Minus, right? We are calculating a slope of a line here, right? A straight line, right? So let's first see the difference of the y, right? Difference of the y is the return of the portfolio minus the return of fixed rate. So that's called excess return of this portfolio because it's the additional return you have compared to risk-free asset. And what's the x here? The x is the standard deviation of this portfolio, right? So this is the ratio, right? Roughly speaking, this ratio corresponding to the number of additional return that you can get for every unit of additional standard deviation, right? And this has a very special name. This is called the Sharpe ratio. Okay. So okay, using the language Sharpe ratio, the tangency portfolio is defined by trying to find a portfolio with respect to the risky assets that has the highest Sharpe ratio. Okay, then let me pause here for a second. Is there a question? Okay, so there's a question. There's a question from the audience. So, what does the curve mean? Black one. The black one means the mean variance frontier for the risky assets, right? So that's for any level of return, you try to combine. Yeah, the mean variance frontier. Yes, exactly. So for every level of return, trying to combine trying to find the weights only among the risky assets correspondingly, and find the optimal one that corresponds to the smallest variance, right? So then that's what you can get, the investment opportunities you can get if you exclude the risk-free asset. Okay. Seems to be another chat. Okay. 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 So that's I hope you find it to be intuitive in terms of the tendency portfolio. And let me come back to the story. Okay. So yeah, this is pretty much what we have, right? So the green line here is tendency portfolio with the highest Sharpe ratio, and this green line is called the capital allocation line. The reason that we find this line is any other line that intersects with the black curve here is treated as dominated. Okay. Okay. So here, okay. So a little bit more math with respect to the tendency portfolio, which actually will be important when we talk about the CAPM. So the tendency portfolio algebraically or mathematically is defined by the following set of conditions. So okay, for now it's basically you need to train the portfolio, which is tendency portfolio, so that it equalizes the ratio between excess return and equalizes for every asset I. You achieve the same constant. What the constant is defined, that is, the excess return divided by the covariance between the portfolio and that particular asset. So that should be equal for every asset, right? I'm going to do two passes of this equation or condition. First, I was trying to convince you kind of mathematically, hopefully, and then I'll tell you the economic meaning with respect to it. Okay. So very quickly, let me go through how it can be derived. So first of all, because of inclusion of the risk-free asset, we need to adjust the the formulation a little bit. So let's say W is still the allocation within the among the risky asset, but then you need to include that risk-free return, and so that you fix it, the return to be R bar. So this is the new kind of formulation when you have a risk-free asset, right? And how do we solve it? Well, this still okay. By the way, sorry, I forgot to mention one thing is if you just want to achieve a return level R bar, and because of a new definition that W only corresponds to the risky asset, we effectively drop one constraint, that is the summation of the weight is 1, because if it's not 1, then the rest of the weights go to the risk-free asset. Okay. So, well, how do we solve it? We kind of write out the Lagrangian dual and trying to write out the first order conditions. And it turns out that if you just write out the first conditions, you can get the optimality equation above. So this VW here is actually the covariance between the tendency portfolio of each asset. And if you laid out asset by asset, you get a vector on right hand side, and then you get a vector on the right hand side. But this is just for particular return level R. But recall that the tendency portfolio is defined as the portfolio so that all the weights correspond to the risky asset. So it suffices to find appropriate level of R bar so that the optimal solution corresponds to the one that does not include the risky asset. So keeping the same optimality conditions, that give us one additional degree of freedom, and this one final degree of freedom is resolved by including the constraint that summation W equal to 1. Okay. So economically, what does that mean, right? So let me first explain in the words, and then talk, and then come back to the optimatic equation. So in words, this is called one-form separation. Okay, so assuming that everybody in the market uses mean variance analysis, know that I haven't assumed any kind of distribution except for the first two moments. So it can be normal, it can be non-normal, as long as we are aware about the first moments. And suppose that every investor agree on the same values for the means and variances and covariance matrix, right? This could be a big assumption. The implicit, justification is that, we as normal people might not have this value, but people on the market should be smart. They should be able to kind of figure out the values on their own, right? So of course, in the second part of lecture, in tomorrow's lecture, we'll kind of actually revisit this to see actually how it's actually pretty not that easy in practice. But okay, so for now, let's say we agree on the values. This is called the homogeneous belief. Then there's a big implication. First of all, everybody will hold the same combination of risky assets, regardless of their specific objective, except for the preference structure that I introduced. So yeah, one might be more risk averse, one might be more risk seeking. So that combination risk asset is called the Tennyson portfolio, right? If you're more risk averse, you tend to hold more of that Tennyson portfolio and less of the risky asset. If you're more risk averse, you are kind of tend to hold more of the risky asset and less of the Tennyson portfolio. And if you're more risk seeking, or more kind of return driven, you are going to hold more of the Tennyson portfolio and less of the riskless asset. But no matter what the risk aversion level will be, everybody will agree on the same relative proportions among risky assets. Okay. And then actually now gradually leads to transition from modern portfolio theory to CAPM, which is our second part. Okay, so so what is CAPM about, right? So and the CAPM is developed to address the fundamental question. So that is why? Okay, try to explain the returns. How do the returns come there in the first place? So why do how to come up with economic mechanism to explain the returns? With the correct mechanism, we are trying to predict them, right? So there's this old saying that with great risk comes great return. But at the end of the day, what is the risk? Or what is the risk that is, rewarded by the market? And how can we make sense of the relationship between risk and return? In the sense that with additional return, how much, with additional risk, how much return should we get? So yeah, the CAPM is developed as the first part of the ocean of asset pricing models to address this question. It has many applications. Two main one of them is first one, trying to identify undervalued stock. For example, if you have an understanding of the risk of the stock, the CAPM should be able, or any asset pricing model should give you a sense of the return of it. But then you can see the historical return in it, and then hopefully you will have a sense of whether the stock is undervalued or not. Another way to do it is you can have a more fair evaluation methodology for the investors out there in the market, right? So some people turns out to make more money than the others, but that does not necessarily mean that those investors are more smarter. They may just have turned out to be be loaded with more risks, right? So can we find a more fair way for performance evaluation when we also put the risk into perspective? It's also one of the applications of asset price models, including CAPM. Okay. So come back to the one that I owed you, that I promised to talk about. That's like a revisiting of the the optimality condition of the tendency portfolio. So that's this. This is the one that defines the relative portions of tendency portfolio, except for the final weight, because you can kind of the last degree of freedom is everything kind of grows proportionally. So tendency portfolio is such that the weight is sum up to 1. Okay, so economically, what does this tendency portfolio mean? So simply speaking, it says that all the assets at optimality of tendency portfolio should have the equal, I wouldn't say it's sharp ratio, but very, very related, right? It have the ratio between excess return and the covariance, the covariance structure. And the covariance structure actually will have a correspondence to the marginal variance of the whole portfolio. So essentially, this equation is derived from the marginal perspective. So you think about if you put a little bit of extra weight on one asset, that brings you that contributes to the return of the portfolio by that excess return of that portfolio. But at the same time, it also contributes to the variance of the portfolio, roughly speaking, proportional to the covariance. So you need to think about both the excess return and the marginal contribution, both the marginal contribution to the return and the marginal contribution to the covariance. And optimality, this marginal benefit should be equalized. So that's why this is derived, and I hope that makes sense. And also, I do see some questions from the audience. What's the meaning of relative proportion? Right. So I would say, yeah. I hope I just explained that. So the relative proportion. If you're meaning the ratio here, so that's like okay. So basically, you're trying to find a portfolio. By definition, tendency portfolio tries to maximize the Sharpe ratio, not the return. And because of that, you need to both think about the marginal contribution of each asset to the return of the portfolio and the variance of the portfolio. And you need to kind of have a good balance so that the ratio of the return and the marginal ratio of the marginal contribution to the return and the marginal contribution to the variance are equalized across the portfolio. It's like you are doing a constraint optimization, right? So okay, so and that's pretty important for the derivation CAPM. So that's why I chose to spend a little bit more time on it. Okay, so remember this this ratio, this optimal condition, and we are going to do some magic around it. Okay, the first one is if the ratio is equalized for each asset, then we should have the same ratio for the tendency portfolio itself, mainly to do some linearity properties of the covariance and the return. So now we do have this relationship that links the return and the covariance of every specific return and something that's only that only concerns the tendency portfolio. Let me do it more clearly, right? So if I remove the terms, we have an expression, or I would say a prediction for the expected return of every single asset, right? This so this return will depend on several things. If you hold the tendency portfolio as given, then the return only depends on the covariance between the asset and the tendency portfolio. Okay, so this comes from the optimality equation of the tendency portfolio. Okay, so let's continue. Okay, so here are the assumption set of CAPM is much longer than this, but I'm picking on the one that I feel to be most relevant and important here. Okay, So the assumption is that CAPM assume that everybody uses the same invariance analysis and everybody uses the same estimates of the expected returns variance and stuff. So that's the homogeneous belief. Then, as we argued from the one-form separation, the proportion of the risky asset, kind of is fixed. The relative proportion of the risky assets is fixed, and that's observing the the ones for the tendency portfolio, and that's the same for everybody. Okay, but in the end, so CAPM is an economic equilibrium model. So now we have really what we have is the supply, right? Sorry, it's a demand, right? So everybody kind of wants to hold this many portfolios. But if you talk about this whole big market, everybody is doing the same. And eventually at equilibrium or when supply is demand, actually then that will be the kind of the same proportion kind of indicated by the tendency portfolio is also the same proportion of the assets out there available on the market. Otherwise, price will move up and down, the return will adjust, and that will not be stable. But at stability, since everybody is holding the same portfolio, the same ratio is actually the same amount that's supplied, the same amount of assets out there in the market. So furthermore, in the end, we get this result from CAPM that the tendency portfolio, which is a theoretical construction, an optimal solution to some mathematical programming that we have, is actually the market portfolio because everybody is holding the same thing. And then so the amount of the asset traded on the market should be proportional to the one that is indicated by the tendency portfolio. Okay, so that's the part one of the main implication of CAPM. Let me hold a moment to see if there's any question. If no, then I'll go continue. Okay, so part two is here. So that's so CAPM is almost equivalent to its famous so-called CAPM equation, right? So okay, so this is what we derive. So this is equivalent to the optimality condition of tendency portfolio. So it's a consequence of that. So we know that tendency portfolio is set up so that this is satisfied, right? So this is the property of tendency portfolio. But then, because of argument, that's an economic argument, before tendency portfolio is actually equal to the market portfolio, we get this, right? So basically, we are replacing tangency portfolios with market portfolios. So here you can see I have a beta here. So beta is defined as the rate as this. Okay, you can now see my laser pen here. So this one is defined as beta, but replacing tangency portfolio with market portfolios. Okay, so and this is called the CAPM equation, right? So and finally, if you look at it, it's really a linear regression, right? So you can verify the linear regression, right? On the right hand side, that's like expected return of that's the expected return of the asset, and then on the right hand side, what you regress on is the return of the market return, and the coefficient here is proportional to the covariance between an asset and the market, or how the asset co-moves with the market. Okay. So there's one famous kind of product of CAPM. That's the notion of alpha and beta. Okay. So if you think about the linear regression, that's okay. So this is like a theoretical construct because there is no residual value here. Here, this more practical kind of, you can think of you are trying to do linear regression of the return with respect to historical data. So this is the linear regression that you do. And alpha is the intercept of the market, of the linear regression, and beta is the slope you get in the regression. Okay, so that's why it's called beta, right? So beta is slope in regression, and it represents the load of risk of the asset, right? Because it is the single explanation variable of the return. So on the CAPM, the value of the beta is the covariance between the market and the return. Covariance between the market and the return of that particular specific asset. And the intercept of the regression is called beta, right? So it represents the extra return after you have controlled for the risk factor. But because of this CAPM equation here, the prediction of CAPM is that alpha equals 0. That is, everything, all the returns should be well explained by that risk factor of the covariance between market and the return of the asset. Equivalently, you can say CAPM predicts that alpha is 0. There is no kind of extra return of that. Okay. So if this is the first time you have heard of it, it can be a little bit a lot of information to digest. So let me, talk about a little bit more intuition behind CAPM. As always, if you have any questions, please feel free to kind of interrupt me. Okay, so what does CAPM say, or the CAPM equation say, right? So the high beta stocks are more risky, and therefore should be compensated with a higher return on average. So, but if it's the first time we hear of it, okay, so covariance between the market and the asset, why doesn't red necessarily mean the stock? That doesn't mean the risk. Well, there's one story that people kind of tell. So that's why co-movement with market means return, means risk. Because if market is good, everybody's happy, and that's actually some time that you need least about the money. It is when the economic is bad, typically when you will need the money. For example, if the economic is bad, then jobs are hard to get. It's more likely that people are jobless. There's less kind of economic activities in the market, so it's hard to do things, and you need to you really need money to pay back your house loan, so on and so forth, right? So it is because of this that correlation with the market, co-movement with the market can really explain to you, the risk level, right? So you do not want something, your asset, your portfolio returns to be moving along with the market too much, right? In the end, you want it to move opposite to the movement of the market, so that it can be like an insurance, right? When the market is down, it turns out to have more returns, then that's like an insurance. But the market, knowing that, compensates for that, right? So if you buy something that you do not want, but still there are some people buy, it must be that the only reason for that is it brings about more returns on average, right? Okay, so a little bit more discussion, a big intuition, a big insight from the CAPM is that economically, what you get compensated for is the covariance with the market, not the variance of the portfolio or the risk, not the variance of the portfolio or the asset themselves. So, and how to make sense of that, right? So even if we believe the CAPM assumption in the first place, say people are more kind of, what they hate is the variance of the portfolio, but at the end of the day, what they get is the covariance with the market. That seems to be a contradiction. How to make sense of that, right? Maybe a very extreme example for that is you can think of an asset which has a huge variance, but very low covariance with market, say zero covariance with the market. So the CAPM says, because the covariance with market is zero, you will not have any kind of a risk premium or compensation for that high variance. Why is that? Because CAPM, underlying CAPM, so underlying CAPM, there's this notion of risk diversification. So implicitly, you are thinking about you are holding a large pool of assets, a well-diversified portfolio, and then you can kind of adjust your weights accordingly to perform risk diversification. But if you have already done the risk diversification, you don't really need to worry about variance, because if a lot of variance kind of independent with each other, and then you hold very kind of reasonable weights, then the diversifiable risks can kind of go away. So in the end, it seems to be an asset with high variance. It's actually an asset with very low variance or even close to zero variance after proper risk diversification. And because of that, you don't need compensation from the market. So in the end, I would say, to summarize CAPM, I would say that the big insight from CAPM is that, even if your objective is a low variance, market only compensates covariance with the market, or equivalently, market only compensates the risks that are not diversifiable, and combined our earlier terms, the systematic risks. Okay. Let me see if there's any question. Okay, no. So let me continue. Okay. So let me talk a little bit about people's perspective on CAPM. So first of all, I would say that I wouldn't say that CAPM is very well verified from empirics data, but CAPM is one of its first kind in this line of thought. It's actually one of the first like well celebrated models in the finance at all, because of this clean intuition about what alpha, beta, systematic risk, idiosyncratic risk. So it's a foundation of a lot of other models that comes after it. So, and a lot of these notions and concepts and ideas from CAPM is still preserved in other models, right? So, for example, the notion of alphas and beta. So you can hear everybody talk about them all the time, even nowadays. So, okay, in practice, this is how you could test CAPM. So, you run the linear regression, you see the return every day, and then you see the return of the market every day. Also, you do not have to observe the tendency portfolio. You can assume that you observe the return of the market every day. And then you run the linear regression. There are a lot of issues with respect to regression. For example, the estimation error, which we're going to talk about later. The non-stationary problem, which we'll kind of already talk about tomorrow. So, you can think about beta is not static, right? If you really kind of run a regression, it's dynamic, right? So things change. So you have this thing that, if you include too much data, maybe 50 years ago, it's totally different beta than the current now, right? So that's non-stationarity. Estimation error is, okay, if you only focus on yesterday, you do not have enough data to kind of make any statistical reasonable conclusion. There's also this modeling issue, right? So I said that CAPM could provide some guidance on stop picking. Okay, let's say we run a grid regression and find that the alpha is indeed positive. Okay, so how should we make sense of that? So using CAPM and and assuming that regression is done in the correct way, that means that this alpha this asset has actual return after controlling from the risk, so it is undervalued. So you should definitely buy that. So that's possibility number one, and that's the good possibility. But the bad possibility, it might be that the security actually is not mispriced; it's correctly mispriced, it's correctly priced, but instead the CAPM is wrong, right? So that motivates a lot of empirical research, to test the CAPM. So one of the way to do it is, and people have done it, is you take a large number of stocks, and then you kind of break it into two parts, as we kind of do very frequently nowadays, but in two parts, and you ask the beta before, and then you kind of have a sense of the predicted return using the betas in the first part of data, and then you kind of try to predict the return of the second part, and see whether the prediction is accurate, right? So here is roughly the results of those kind of tests. A good news is that high beta stocks indeed correspond to higher returns on average. But the bad news is that the correspondence is not as strong as what a CAPM would predict, right? And also a lot of other stock characteristics related to the firm, related to the stock itself, such as the book to market ratio and profitability, actually explains the returns better than the data, better than the beta itself. The beta means the CAPM beta. So, okay, so that's what I meant by CAPM that doesn't hold the empirical performance too well. There are actually, in both stories with respect to test results too. One of the discussion by Rowe and Fama is that maybe the CAPM is still right. It's just it's untestable. Why it's untestable? Because the true market portfolio is never observable, right? So in the test that you do here, people usually make the stock market indexes for the market portfolio, such as the Standard & Poor's 500. But is that really accurate, right? So the theory says we should have a portfolio of all the possible assets in the world. So that should include stocks, that should include Chinese stocks, Japanese stocks, Singaporean stocks, so on and so forth. And also bonds, ETFs, gold, so on and so forth. You should include everything. Okay, everything, those I have mentioned, you probably can test them, but they're actually something that you cannot even measure them. For example, the so-called human resource investment is very hard to measure. You can think of it, for example, at a young age, you want to invest in your education in order to get better skills so that you can achieve higher wages in the future. So that kind of investment is very hard to observe from the data, but that's actually a very big part of the investment in the so-called all asset market portfolio, right? So because of these kind of problems, one might argue that CAPM is actually not testable, so it's not even wrong, I would say. So it's untestable, right? So you cannot. So yeah, the CAPM is a very beautiful theoretical construct that is very hard to directly apply in what asset pricing models are aimed to look at, right? So that comes to the market model, which more gradually goes to the factor models. Okay, so let me start from the market model, which is also called the single factor model, which is highly inspired by CAPM. Okay, some people say it's kind of equivalent to CAPM. It's actually not that equivalent, but very, very similar. Okay, so the CAPM model, the market model looks at the following equation, right? The return on you regress the asset return on the market returns, and drop the economic assumption, the behavioral assumption of the CAPM, meaning everybody uses the mean variance analysis because in fact people might worry about something more than mean and variance, say third moment, the extreme values, so on and so forth. And different people do not have the same estimates of the parameters. That I believe that's pretty reasonable. And also, in terms of a tester, CAPM, in order to use CAPM implicitly assume that there's a market index that reflects the return of the generally unobservable true market. right? But instead, let's assume a different thing. So let's just pick an observable market index, let's say S&P 500, to represent market. And instead of assuming, the people's behaviors, we assume, economic statistical structure directly. So we assume that the epsilons here, we write out in the equation, is uncorrelated across assets. Okay, so it's kind of assumed directly that the diversification effect exists. Instead of in CAPM, you kind of derive from a mathematical programming solution. Okay, so using that, you kind of can replicate the prediction. The market model will give exactly the same prediction as the CAPM. So you can think of it as re-deriving the CAPM equation. Right? So let me do it quickly. So the market effect model is defined by this regression. And if in addition, there is no near arbitrage opportunity. So what's a near arbitrage opportunity? That's an opportunity to gain a strictly positive return with almost no uncertainty. So that's arbitrage. Arbitrage means profit with no risk. A near arbitrage you can think of as a profit with nearly no risk, right? And also assume that there are a lot of securities on the market, which I hope this is reasonable. I think it's pretty reasonable. Okay, and then you can replicate the CAPM equation. That is, the expected return of the asset is purely dependent on on the return of the market with certain parameter behind it, parameter in front of it, and there's no intercept. Equivalently, the market model says alpha equals 0. Okay, so let me do it, very quickly. Again, it's not that we wish to observe it, but let me just give you a flavor why alpha equals 0. Now this based on a different argument, is based on the so-called no arbitrage argument. So the market model is also called an arbitrage as a pricing model. Okay, so suppose that alpha is not 0. Okay, let me pick a direction. Let's say I pick alpha is positive. Okay, so on the right-hand side, this is the model. This is the return model for the market model. So this is assuming to be correct in the first place. Actually, all the assumption kind of is observed by epsilon. So it's kind of we have assumed that epsilon are uncorrelated across assets. Okay, this is what you can do to achieve a positive return with almost no risk. Okay, so you can construct the following portfolio. You borrow $1 and you use that $1 to invest in assets. At the same time, you sell beta amount of basically you sell one share of the asset. You sell one unit of the market equivalent to beta I dollars. So you get beta I dollars, and you put all the money of those money that you sell, the beta I dollars, to buy the risk-free asset. Okay, so in the end, you borrow $1, you invest in asset I, so you have zero money, zero net money flow. You sell the market portfolio. You sell the S&P 500. You can call it. You think of it as an index fund. You sell that. You get some money. You put all the money into the risk-free asset, right? So in the end, it's a zero net cost portfolio because the net money flow by doing this sequence of transactions is 0. That's at day 1. Okay. So now let's talk about what you get in day 1, right? That day T, right? That means the end of the horizon, right? So because of borrow money after 1 year, you need to pay back with interest rate. That's RF. Since you invest in $1 in asset I, the return you get is RI. Since you sell the money in the market, so you get a negative of its return proportional to the money of the sale. That's beta I times R of market. And since you long in the risk-free, you get beta I times the risk-free rate, it's RF. right? If you combine everything else, in the end, what you get is alpha I plus epsilon I. Here, epsilon is the residual term. Okay, so if you do it for every asset like that, in the end, you will get an alpha for each asset and an epsilon term for each asset. But using our assumption, the epsilons are, uncorrelated across the assets. And if the number of assets is sufficiently large, those epsilons can be diversified away, especially compared to alpha. So in the end, what you get is the positive alpha for each asset. But then in the end, you get approximately meaning you still need to do some analysis about the epsilon terms. But it turns out that there's a very, very small term that's negligible. And at the end of the day, you get a positive return, strictly positive return on that asset with almost no risk. Okay. And then what happens next? If there is such profitability opportunities, everybody will flood in to buy this asset. And then because of the supply and demand, this asset will become more expensive. Once this asset becomes more expensive, the return of this asset will go down. And eventually, in a no-near arbitrage environment, ROI must be zero in the equilibrium. Okay, I mean, if ROI is negative, you kind of can do it in the reverse way, and also in the same argument, it should not exist long in the market. So in the end, alpha I equals zero for each asset I. Okay, so that's one factor model, and this similar idea can be easily extrapolated to a multiple factor model, right? So the multiple factor model is motivated by the following arguments, right? So we have assumed that idiosyncratic risks epsilon I are uncorrelated. So that means that all the epsilon i's should correspond to the firm-specific or idiosyncratic factors that's only depending on each individual firms. Oh, right. But shouldn't there be some kind of thing that apart from the market that affects a group of firms or a group of assets simultaneously? For example, the oil price should be able to affect all the asset prices, let's say stock prices of those that deal business with oil, right? The interest rate definitely should be relevant to the stocks that for, like, say, the banks, hedge funds, and so on and so forth. So those factors are not truly kind of may not truly represented by the market portfolio. But if that happens, that means that the epsilon I could contain some components that's effective globally or corresponding to the systematic risk. But if that happens, it's no longer a reasonable assumption that epsilon i's are uncorrelated across assets, and hence that diversification away argument should break down when that concern really happens. So that's why people start to think about the multi-factor model. The multi-factor model is defined in the same spirit, but using multiple factors, right? So previously you can think about we only have one factor, so there's only one beta, but now we have multiple risk factors. Here in this case, we have k risk factors, so we have multiple betas. But CO is defined by linear regression. Okay, so F1 is usually the excess return of the market. Okay, so there are some other factors. For example, factor 2 can be defined as the return between small companies and the return of large companies, which I'll explain more later. Okay, so the assumptions of a multi-factor model is really similar to that one of the market factor model or the one-factor model. So it assumes that after controlling for the multiple factors, the absolute term becomes uncorrelated, right? So if you believe in the multi-factor model, then if you only control for one factor, the rest of the term actually will not be uncorrelated. But now that we have control for sufficiently many factors, we have hopefully a weaker assumption that the remaining residual term is uncorrelated across assets. Again, there's no arbitrage opportunities. And again, we assume that there are sufficiently many securities so that the diversification story can still hold. Okay. Okay. So on a multi-factor model, the following properties should hold. First, because of this regression, the epsilons should have mean return, zero return expectation, and also the covariance between the residual term and the factors should be zero. So the residual term should be uncorrelated with all the factors. Okay, the diversification effect is what has been assumed explicitly. That's the covariance between the residual terms is zero. So the residual term uncorrelated across SS2. Finally, the property, now it's become a property. If you believe in the first two conditions, this will be result that the alpha also is zero on the multi-factor model. And that's also by a non-arbitrage argument, similarly as I did for the first single factor model. So if the alpha is not zero, then you can construct different portfolios using diversification effect and the assumption of the regression that you can construct a portfolio with strictly positive return and almost no risk, right? So in the end, on a no arbitrage environment, the alpha should be zero. Except that this alpha on the multi-factor model is a different alpha from the CAPM model, because this alpha has been controlled for more factors than the factor model, than the market model. Okay, so let me try to, we have talked about a lot of information for now, so let me try to talk about a little bit about the advantages and disadvantages of the CAPM, the single factor model, and the multi-factor model. So, if I compare a multi-factor to CAPM, CAPM need to assume that the investors behave in a certain way. That's the mean variance analysis that I did in the first place. If I compare the multi-factor to a single factor model, because we now have more flexibility to design the factors, the assumption that the inducing credit risks across assets uncorrelated seems to be less strong, right? Because we have more terms to explain the returns, so it becomes easier that the residual term is uncorrelated. However, by introducing more factors, the multi-factor model becomes less specific, right? For example, unlike the market model or single factor model that's well inspired by an economic model, which is CAPM, so it has a lot of good economic foundations and mechanism. So that model is well theory-based and well justified. A multi-factor model does not tell you which factors you should use or you should pick. So you might, at the end of the day, ends up in the wrong factor, and that's problematic because that actually will also lead to violations on the assumptions of multi-factor model. So in comparison, CAPM gives you a very clear message and clean message that there's only one factor out there, and that's the true market portfolio. Okay, so how do we pick factors, right? So there are roughly speaking 3 streams of ideas to find factors. So hopefully we can configure the factors correctly so that we can fully enjoy the advantages of factor models. Okay, this first stream of idea is use some macroeconomic metrics, right? For example, the GDP, a lot of macro factor models. The advantage is that those factors will be very easy to interpret, very easy to understand. Everybody knows what GDP is, at least for those economists, right? But the disadvantage is that it's almost even harder to kind of understand the dynamics of the macro factors. For example, it's very hard to measure, the interest rate of the Federal Reserve, like 5 years from now, right? So there are also micro factors. So micro factors concerns the specific firm characteristics. For example, the profitability, the size of the firm, so on and so forth. So those are also pretty intuitive, but there are simply too many kind of factors that possibly to construct. So you might end up in a overfitting problem, right? So you might be mining data so much that you actually pick up something that fits the historical data that does not give you a very good explanation power in the future. So finally, there's this statistical factors or machine learning kind of idea factors, which kind of actually pushes the idea of macro factors a little bit more. So you can think about doing a machine learning, or you can think about it, first of all, you have a lot of factors and using some machine learning statistical procedures to filter out the factors, right? One of the standard ways to do is the PCA, or principal component analysis. And there are now a lot of more tools to do it, such as the lasso, right? So like the regularization, so on and so forth. So, but that's the same idea, right? So we do not really need the economists to do it. We can look at the historical data and just use the data talk to see, which factors have explained the historical returns well, right? And so it's data-driven methodology, and so that by definition is a good advantage. But usually, what the disadvantage it brings about, which I will talk about more in the next tomorrow's lecture, is that first of all, it can introduce overfitting problems, which may be mitigated or may not, right? And second of all is the interpretability problem, right? So suppose you use a PCA, and then PCA tells you the factor is a particular portfolio with respect to every asset on the market. But what that really mean, right? So if you do not really understand what that factor corresponds to, that could be dangerous, because you don't know whether already encountered into overfitting problem, or you already found a very insightful factor you just do not have understood yet, right? So usually there are 3 to 5 factors in the US economy. So that might be a guidance, right? So there's not many factors at all in the first place. So if you have used your machine learning to figure out 100 factors, that's a flag, right? That either you have picked up a lot of factors that are highly correlated with each other. So in the end, you actually only pick a very few number of factors, or you have encountered the overfitting problem. Okay. So this whole business of factor modeling comes from the famous Fama-French three-factor model, right? So this is the first development since CAPM. So Fama-French argued that CAPM may not be able to be used directly in practice. So they actually introduced 3 factors in the framework that I introduced, that turns out to explain and predict the returns more effectively. So these 3 factors that Fama-French introduced is threefold. It's the following. The first one is the excessive return of the market, that's highly inspired by the CAPM. The second portfolio is about the size of the firm. So to this end, you can think about the factor actually also as a portfolio, right? For example, the excess return is a portfolio that longs in the market and shorts in the riskless asset. In the same spirit, size can be defined as, you know, the returns of the smaller firms minus the bigger firms, or you can think about a return that sells the big firms and use those money to buy short firms. And the return of that portfolio is called the size factor. So here size is defined by capitalization, which is defined as the stock price times the total number of shares in the market. Okay. The third factor is called the book to market factor. So again, it's a portfolio. It's really just a return of a specially constructed portfolio. What this portfolio does is it belongs in this high value of book to market ratio and shorts in low value of book to market ratio. Okay, what does it mean to be book to market ratio? It's the ratio between the book value, that's like the value of the total equity. So you can think about the company, you can count, you know, the value of the desks, the chairs, the computers, the assets, all those money added up is the book value, right? The market value is market capitalization. So that's the total money value that's traded on the stock market. So that's capitalization. You take a ratio, that's called the book to market ratio. So roughly speaking, it tells you, whether it's a big deal, right? If you have a very high book to market ratio, it's a good deal, because if you just count computers and assets of the company, it's a very big number, but it's actually traded on the market at a very cheap price, right? So it's a factor about the value of the firm. Okay, so that's called the three-factor model. Nowadays there's a huge industry about mining the factors. There's this first development of five-factor model, which includes the profitability and investment, so on and so forth. Nowadays, you look at those hedge funds, they have a lot of economists and researchers trying to find more factors that hopefully explain the return in the same spirit that Pharma French did, in their papers. Okay, so I would like to maybe finish today's lecture about different perspectives about understanding factor models. So a first one that's approached from the practitioners is that a factor is a return of some portfolio. It's really no more different from other portfolio, except that it has a clear rule about it has a clear predefined rule in terms of how that portfolio is constructed, right? For example, the market portfolio, the high to low, the big to small, small minus big portfolio, so on and so forth. So in that sense, it's some middle point between what people call as passive versus active management, right? Passive management is something like you just put your money into a fund, or for example the S&P 500 index fund, and never do anything with it, right? You just hope that the value of it grows naturally. Active management is like you look at every details of signals and doing a lot of rebalancings, doing a lot of different very complicated operations with respect to the portfolio. So a factor is something that has a rule that's not perfectly passive, but also is highly regulated by the rule that the portfolio is constructed. So that's first interpretation. The second interpretation is that using the spirit from CAPM, a factor is simply nothing but a source of risk, right? So at the end of the day, there's no free lunch, but different people can have different understandings about what are the risks. If you're a believer of the CAPM, there's only one source of risk, one source of risk that can be rewarded by the market, and that is the market risk, right? But if you use multiple factor model, you are saying that there are different factors that corresponds to risks, and the return of asset should be rewarded by the load factor of each risk factor, by the load amount of the risk factor. So that the total return of an asset is the total load of all the risk factors that you should consider. So now it comes to question of, are those factors beyond the market factor, such as the small minus big factor or high minus low factors, just compensation for more risk, or they are freebies, or something that you can actually think about a very smart strategy that you can beat the market, depending on which interpretation you are standing at. Different people might have different opinions about the real meanings of SMB portfolios or high and slow portfolios achieving higher levels of returns in expectation. So and this is where this investment industry is heatedly discussing and even debating, and all this kind of strategy that talk about finding factors and trying to do it in a highly regulated and highly understandable and highly kind of structured way is called the so-called smart beta strategies. And the smart beta strategies is with respect to the alpha strategies, which tries to find alphas on the market, which corresponds to active management. Some people say it's not possible, but some people think it's possible. So that's alpha strategy. The beta strategy is more like the passive management. So because the CAPM says, in the end of the day, the market portfolio is the most efficient portfolio. So why not just invest in market? And there's nothing that can beat the market in terms of Sharpe ratio. So that's like called the beta strategy. Okay, so that's about time. So let me give a quick summary of today's lecture. So I noticed, today I tried to include a lot of information about some of the most well-known models relative to portfolio management. So the foundation is the modern portfolio theory, and then building on modern portfolio theory is the whole big family of asset pricing models, including the CAPM and the factor models, among others. So those models, especially the later ones, provide some insights on how to regulate the construction of portfolios, because they give you some guidance about what to buy and what not to buy, instead of a purely data-driven method. And also it provides some foundation for more advanced methods, which I'm going to talk about next. In tomorrow's lecture. Of course, they also suffer from serious limitations to be directly applicable, especially the MPT and CAPM. And particularly the one that I'm going to address with the most time and energy is that coming back to a decision problem where you're just trying to construct an effective portfolio, using the framework of MPT assumes that you need to know the mean and the variance of the returns of each asset. And actually, it turns out that the construction of portfolios such as the mean variance portfolio and the tangency portfolio are highly sensitive to those estimations. But at the same time, the estimation is hard because, first of all, it's very noisy. You do not have a lot of data to collect to start with, compared to the number of parameters you need to estimate. For example, if you need to estimate the covariance matrix, it's a huge number of parameters you need to estimate if you have a lot of assets. And you also have non-stationarity problem, meaning that if you date back too long, then something that happened 100 years ago might not be as relevant to something that happens only 5 years ago. So if you include those data, it actually might harm your estimation of parameters, which further leads to the decisions about portfolio construction. So that is what we call an estimation issue. So regarding how to mitigate the estimation issue is what I will spend the most time in tomorrow's lecture. Okay, so we have 15 minutes left. So I will kind of hold here to answer possible questions. Okay, I have a question from the audience. How to measure or calculate these factors except for the market factor? Okay, so okay, good. So for the 3-factor or 5-factor, that's easy because there's a simple rule, right? So like, for example, the small minus big. So you just, okay, what Pharma French did was he looked at the historical return of all the assets traded on the US market. He divides the market into, for example, 4 parts. The first top percentile of the firms with the largest size, and the bottom 25 percentile of the firms with the least size. And you do an average return of those firms minus the average return of those with largest size. And then you get the historical data on the return of that factor, right? And then you just regress your portfolio return. You just regress your return of any specific asset on the historical observation of the return of that factor. So that's how you do for the small minus big. You can do a similar thing for Hammond-Stowe and so on and so forth. Okay, question. What is the typical planning horizon? That's a good question. So I would say depends. So actually, there are like different papers with different planning horizons. In this example, I'm talking about maybe 1 year, but I would say maybe if you play the card of market is the most efficient, you had better make it very long. So there's this famous observation that in the long run, even the S&P 500 is unbeatable. So that's actually pretty repeatedly seen, right? So there's no hedge fund that can be kind of maintain their level of profitability over a very long time. So in that sense, I would say the investment horizon should be very long. And also that's actually what some people did. But when you have but at the same time, if you have a investment horizon that's very long, you kind of also need to deal with, let's say the multiplicative return thing. So you need to be careful about defining the return. For example, what you definitely do not want to do is you take the return, because the return are percentages, right? You definitely do not want to take the return of each year and you sum it up and take the average. That's no good, right? You need to take a geometric mean of the return. You have to be a little bit careful about that. And the second thing about very long investment horizon is that not every investor is indeed patient enough to live in an investment horizon of 50 years, right? So, for example, if you've seen a hedge fund that has been not making profit for 5 years, probably the hedge fund will already be driven out of the market. So in that sense, you might also think about an investment horizon that's shorter, but then it might be a less good approximation of these factor models or CAPM to reality. Yeah. So to summarize, if you want the CAPM to be working better, you want a longer horizon. But if you want to be more practical, sometimes because of the specific preference of the investor, you also need to worry about shorter investors, shorter investment horizons. Does that answer your question? One more question. How will transaction fee? How transaction affect the model? Good. Okay. So that's why I'm trying to be careful about the boundary here. So I'm now more talking about the so-called static portfolio management. So I'm not talking about rebalances. So that in that setting, the transaction fees is less of a concern. But when you talk about the rebalancing costs, the transaction fees, then the transaction fees will be much more relevant. But that's kind of more orthogonal to what CAPM will say, because CAPM does not tell you how to rebalance, right? So, and there are actually a lot of different studies about dynamic portfolio management. That's typically more harder. If time permits, I will talk about some of it tomorrow. But there's some result I want to say. I found, in case I do not have time, tomorrow, I found it pretty impressive. That is, if you're okay with, very low or even zero transaction fees, there is a way that's model free. Like you do not have to make any assumption on the model, and you do not have to know any knowledge of the market. You just need to rebalance in a very specific way. In the end, you will achieve a growth rate asymptotically as high as any optimal portfolio in hindsight. What does that mean? So it's like if you have 50 years, right? And then looking back, you say you can have rebalance, you can redefine your portfolio, but it's a static portfolio, right? So it's a constant portfolio. As a sub case, you can think about any specific asset. Look back and see what is the stock that has the highest return. I can guarantee you that if my investment horizon is long enough, without knowledge of that information before the end of time horizon and just rebalancing it properly, I can achieve almost good performance as the best single asset in hindsight. And actually the result is stronger. It's the best so-called constant rebalancing portfolio in hindsight. And that is called the so-called universal portfolio. And then there's this further development of so-called online convex optimization, and basically able to incorporate any convex objectives and being able to achieve any optimal static decision in hindsight with almost negligible performance losses. So I find that to be pretty impressive, except that it's highly impacted by transaction costs. So I would say the fact that you do not see that in the market too often might have a lot to do with the transaction cost. Okay, sorry, it's a very long answer to your question, but does that answer your question? Okay, question, is there a research on the application of machine learning on portfolio? Yeah, definitely a lot, I would say. For example, yeah, the factor picking, definitely one of them. So personally, I'm more interested in the dynamic portfolio management I was referring to, like and that will be a combination of so-called online convex optimization, which is a theoretical tool coming from the theoretical machine learning, and its application to dynamic portfolio management. So definitely there is a research. Yeah, and depending on the formulation, there's a lot of more researches, right? So, for example, if you allow yourself with more structures, for example, if you assume that the returns of each period, for example, if you talk about dynamics, for each period is so-called IID. IID means independently and identically distributed. then there's a lot of things you can do, right? So you can use all the statistical tools, you can form robust optimizations, you can form different ways to deal with this uncertainty and model estimation. Then you can kind of relax some of your models. You do not assume to be RID. Instead, you assume a very specific statistical property, and then you can deal with it, right? For example, back to machine learning, there is this notion of reinforcement learning, right? So you assume that the market now it's become more statistical and more machine learning-ish. So you assume that the model is, for example, the market evolves like a Markov chain, except that you do not know the transition kernels of the dynamics. And the question is, can you kind of learn it and kind of optimize it at the same time, right? So, and that can be much dealt with using the tools in reinforcement learning, so on and so forth, right? But all of them, I would say, builds on some models. So I wouldn't say that it's model free. So if you allow some structures, there's a much rich literature that you can go to.
一帆，
嗨，
哎，
老师，
时间差不多了，也感谢你刚才回答了我跟杨毅的问了几个问题啊。
没有，没关系，
挺好挺好，这个今天的讲座非常精彩，然后我们也非常期待这个明天的这个讲座，然后
好的，
那我们明天再见。
好的，谢谢金老师，那就
今天感谢啊，非常感谢。
好，谢谢邀请，再次感谢邀请。那感谢各位老师同学今天的时间，那我们就明天这个时候再聊。
好。
Recording stopped.
那就明天见。
明天见啊。
好的，行。
好的，
好，再见。
再见。